Alright. Hi, my name is Ryan O'Neal. I'll be talking today about Chapter 4 Income Statements. The first question I developed was, what is the use of an income statement? It presents a summary of the company's revenues and expenses for a period of time, unlike the balance sheet, which only presents a snapshot. Second question is, name 5 components of an income statement, which are revenue, expenses, operating expenses, cost of goods sold, and net income. There are many more to this, but those are just 5 basics. Third question is, what is accrual concept? The accrual concept records revenues when they are earned, not just when they're paid. So if somebody bought something in December and just told them that they were going to pay for it in February, the accrual concept would make sure that the revenues showed that in December it was bought, even though those revenues have not been earned yet until February. It would go on the December's income statement. This is a good way to manage your business and to see exactly how your company is doing as far as revenue and expenses for the month. Uh, Fourth question is, what is revenue? Revenue uh, is what is earned by a company through the cost of goods sold and services performed for that company. The expenses are expenditures made to generate revenue for the company in a certain period of time. 6 is, what is net income? It is the difference between revenue and expenses for a specific period of time on the income statement. 7 is, interest and income taxes are used how? They're subtracted from the revenues and expenses before determining the total net income. 8 is, what are bad debt expenses? These are the allowances for debt that will not be paid or collected in time needed. Basically, this will give you a bumper cushion to, if anyone, say, accrues any kind of debt with you, purchasing an item in, say, December, and you're expecting it in February, and it doesn't come in, say the business winds up shutting down or has to liquidate, and they never pay you, they have to take into account that bumper cushion to assure their revenue will be on target for the year. Question 9 is, name a transaction that affects the income statement. A couple of those are sales, cost of goods sold, gross profit, and operating expenses as well. The 10th question is, what effect do sales have on the income statement? Sales have 2 changes on the income statement in the revenues and expenses category. Obviously, if you sell a good, you're going to document that into revenue. Only after you subtract the expense of the cost that the item had on your business to purchase it, and the restocking of that good to sell more. 11. What is the difference between the cost of goods sold and gross profit? Cost of goods sold is the cost of all inventory sold in the period of the income statement. The gross profit, however, is the difference between revenue and cost of goods sold before the operating expenses are calculated. 12. What are operating expenses? These are the cost of running your business or company. Basically, it's going to be any kind of gas, mortgage, utilities that you're going to need to keep your business running from day to day. 13 is given an example of a business transaction, obviously selling inventory of the business or its own services that its employees provide. 14 is, what are other operating expenses? The only thing I could really think of on this one would be an example of petty cash. Basically, it's not going to be included in the income statement for every single transaction that the petty cash offers, but as time goes on, these expenses can wind up adding up. And say if you buy a small tool here or some kind of dish detergent, something just small that you don't need to put in a bulk order for, this can add up over weeks or months depending on how much you use it, and then it'll wind up showing up on the income statement. 15. What is the cash basis accounting? Cash basis is like the accrual basis. The only difference really is that accrual is on what is it earned for when it's performed. So if you sell a good, like I said, on December and they were basically write an IOU for February, then that's accrual. But as a cash basis, you're going to be paying for it when you get the item. So if you go up and you buy a Christmas gift in December, you pay for it in December, the company documents that, they're using a cash basis. Basically, it's from when money leaves hands and changes hands for the product. After reading this chapter, I think the three most important parts covered by this author are: one, parts to an income statement. Obviously, you need to know all the parts, and you can't leave one out, or else your numbers are going to come up wrong. Two, types of accounting used as far as the cash basis and accrual basis. These are a big determiner. A cash basis can only be used for a small business, but 99% of people use accrual due to the JAP. The third one is cost of goods sold and gross profit. You need to know the difference between these because they can throw your sheets off if you wind up miscalculating this how you need to have them. My name is Ryan. This has been Chapter 4, Income Statements. Thank you.